All right, let's get right into this explainer. Today, we're putting on our professional sell-side analyst hats. Our mission? Unpacking the true intrinsic value of Atmus Filtration technologies, ticker symbol ATMU, strictly using the fundamental data reported in our source documents. We're going to strip away the market noise, ignore the daily stock market chatter, and rely entirely on structural valuation models to see what this business is actually worth.
We're going to structure our analysis today like a classic equity research funnel. We'll start with the target, move through absolute valuation, touch on DDM and residual income, check out relative valuation, hit on some advanced constraints, and finally, deliver the verdict. Let's do this.
Starting right off with Part 1, the target, Atmus Filtration.
$54.25. That is exactly where ATMU's stock price is sitting right now. And just for some context, that is dramatically higher than its 52-week low of about $34. We're looking at a stock that has surged roughly 57% from its lows, giving it a market capitalization of just over $4.4 billion. So the market is clearly feeling optimistic. But is that optimism actually justified by the underlying business?
Well, before we start questioning the price tag, we've got to look at these efficiency metrics, because they are honestly incredible. We're talking a massive 54.8% return on equity and a 26.2% return on invested capital. What does this actually mean in plain English? It means management is brilliantly effective at taking the capital entrusted to them and turning it into cold, hard profits. An ROE over 50% is genuinely rare and points to a highly defensive, cash-generating business model. The business is undeniably strong, but we still need to figure out if the price is right.
Moving on to Part 2, we're diving into absolute valuation, specifically looking at some DCF insights.
So, to build our discounted cash flow or DCF model, we pulled our critical inputs straight from the source data. Trailing 12-month free cash flow is sitting at a very healthy $148.8 million, with a literally staggering year-over-year growth rate of almost 162%. Now, full disclosure as your analyst, because the specific weighted average cost of capital, basically the company's cost to borrow and fund itself, and the explicit terminal growth assumptions are totally missing from our source filings, we can't just construct the discount schedule from scratch. Therefore, we have to rely directly on the source's internally calculated fair value outputs, which have already digested these explosive trailing cash flows.
And here is the massive reality check. Based purely on that free cash flow DCF model from our source, AMU's intrinsic fair value per share, it's only $25.54. Take a second to process that. We are looking at a business currently trading at over $54 a share, but when you run the hard math on the actual cash it produces, the model says it's worth less than half of that.
So what does this actually mean for us? It reveals a massive negative margin of safety of over 112%. Look, in value investing, you always want a positive margin of safety, right? You want to buy a $50 bill for $30. But here, you're basically paying $54 for what the cash flow model says is a $25 bill. This heavily suggests that the current market price implies a future growth rate way beyond what historical cash flows can actually justify.
Now, to be completely thorough, if we shift our absolute valuation over from a strict free cash flow model to an earnings per share or EPS model, the picture does improve a little bit. The EPS fair value jumps up to $43.04. Net income can sometimes smooth out big capital expenditures that aggressively hit free cash flow, giving us this higher baseline. But notice the math here. Even at an optimistic $43 fair value, we still have a negative 26% margin of safety. Across both absolute models, ATMU is fundamentally overvalued.
All right, Part 3. Let's look at the limitations of the DDM and residual income models.
We can't just stop at the DCF, right? We also have to test the dividend discount model, which values a stock by forecasting future dividends and discounting them back. But here's the catch. We can't reliably apply a multi-stage DDM here. Why? Because AMU's dividend policy is practically a newborn. They have a minuscule dividend yield of 0.41%, an incredibly low payout ratio of just 8.4%, and only 2 consecutive years of increases. There simply isn't a stable, mature dividend history there to anchor a long-term valuation model.
Okay, so what about the residual income model? This usually values a company based on its book value plus the present value of its expected future residual income. Basically, the profit it makes above its required cost of equity. Now, given that massive 54% ROE we talked about earlier, you'd think they're generating tons of residual income. And they probably are. But we actually have to skip this model today.
Our source data lacks the specific stated cost of equity we need to calculate the precise equity charge against its book value. Making up a generic cost of equity here would just introduce way too much noise into our rigorous analysis.
Moving right along into Part 4, Relative Valuation versus History.
So the absolute cash flows are pointing to overvaluation, and the dividend models don't really fit. Let's shift gears entirely and evaluate ATMU using relative multiples. Before we look at the numbers, I need to raise a quick external assumption flag. Our source documents do not identify external industry peers. So instead of guessing and arbitrarily picking other filtration or industrial companies, I'm substituting external peers with ATMU's own 3-year historical baseline. This is actually a highly effective way to gauge relative value, asking if the stock is expensive today compared to what it usually trades for.
These comparative metrics really spell out the whole story. Across almost all standard relative data points, AMTU is currently trading at a really noticeable premium to its own historical self. The PE ratio is at 21.6, which is over a 21% premium compared to its 3-year average. Enterprise value to EBITDA is up 5.5%, and the price-to-sales ratio, it's sitting at 2.50, a hefty 26% premium over its historical norm. The market is just willing to pay significantly more for $1 of AMTU sales and earnings today than it has over the last 3 years.
Part 5. Advanced Constraints and Data Limitations. As diligent analysts, we've got to explicitly state our data limitations when it comes to the more complex valuation frameworks. First off, we're skipping the sum of the parts model because the source documents just don't give us distinct business segment financials. We also have to skip the adjusted present value, or APV model, because we're missing the detailed schedules needed to calculate the value of those debt tax shields. And finally, an asset-based net asset value model, we can't rigorously calculate that without fair market restatements of individual balance sheet line items, which just aren't provided.
But let's pause for a second. Does missing that asset liquidation model actually hurt our analysis? Honestly, no. Even if we could do a full liquidation analysis, ATMU's incredibly strong 16% return on assets tells us everything we need to know. This is a highly operational, highly profitable business whose value far exceeds the sum of its physical parts anyway. You wouldn't buy this company to strip it for parts. You buy it for its cash-generating engine.
And finally, Part 6, the final valuation verdict.
So we've looked at the current pricing, we've run the absolute cash flow models, compared the historical multiples, and addressed our data constraints. And we're left with this really fascinating tension between the underlying business and the stock price. The bull case is undeniable. ATMAU has incredible capital efficiency with a 54% ROE and immense trailing free cash flow growth over 160%. It is a fantastic business. But man, that bear case is just as loud. Our absolute valuation models are screaming that the stock is severely overvalued, offering a $25 fair value against a $54 stock price, combined with the fact that it's trading at hefty premiums against its own historical multiples.
So, based strictly on the data we've rigorously modeled in this explainer today, we really have to ask ourselves, is ATMU a brilliant business that is simply priced for perfection by a super optimistic market? Or, with that massive negative 112% margin of safety, is this a fundamental overvaluation just waiting for a harsh reality check? Does operational excellence justify ignoring the fundamental math? It's an absolutely critical question to consider before putting your capital on the line. Thank you so much for joining me for this explainer, and keep doing the math.